Now, complete change of theme, although, as ever, in this global world, everything is related. I'm joined by Michael Wu, Fitch Ratings Director for Asia Corporates. We're going to talk about property stocks here in Hong Kong. Very good day. Thank you very much for joining us today.
Thank you very much.
That link to what's going on in the US, we have an email which highlights that. It's come from Jeff. I'm just going to read it out here. It says, the recent rise in property prices has been driven by low interest rates. The vacancy rate for Hong Kong residential property, he says, though, is high and rising with falling rents. So how does that support higher property prices in the long term? This is the issue in Hong Kong, isn't it? That because of the link to the US dollar, the peg to the US dollar, Hong Kong interest rates are, we don't know for sure, but they are potentially unreasonably low, and that boosts prices, yes?
Yep. I would say like the current boom right now, other than low interest rates, at the same time it's driven by like hot money everywhere in the world, whether we are talking about China or other parts of Hong Kong or other parts of like Asia Pacific. Economic fundamentals and property prices right now, they are diverging. And in our opinion, at some stage, this kind of gap has to be narrow. But I guess the key is whether property developers are able to capture or take advantage of the current short-term boom and to like consolidate or solidify their balance sheet.
What's your initial impression? We're going to look at some specific companies, but in general, have they been able to take advantage of that rally?
I would say like the property developers, in whether we are talking about Hong Kong or China, they are able to take advantage of the short-term boom, and they dispose lots of their inventory, unlike 2008, and their balance sheet looks much, much better now than like 6 or 1 year ago.
Okay, so they offloaded the property that they thought they were never going to be able to sell. They managed to get it off at what they think is a pretty good price.
Exactly.
Have they done much tapping of the market as well?
In terms of tapping the market, for example, like Shima Property has tapped the market like for around like 2 billion of like fresh equity. But for other, when we talk about like A-rated companies in Hong Kong, they are they tap the market in terms of they go to banks for new financing, but they do not have like fresh equity yet.
Okay, fair enough. How soon do you see a change, by the way, just particularly on interest rates? I mean, a mortgage costs, what, 2%, 2.25% or something like that at the moment. It's incredibly low. Are we likely to see that rising anytime soon, do you think?
Well, perhaps within the next like 4 to 6 months, we'll be unlikely to see like a rise in interest rate. But when we get into like 2010, perhaps, okay, we should have more concern. And that's why, okay, there are lots of like short-term investors or speculators in the market right now. They want to flip as much as they can, like within, like say, like in 3 months' time.
Okay, so they're going to get rid of it before everything's comes crashing down. Let's take a look at a couple of the stocks which are in the market. Might as well start with the biggest of the bunch. That is Sun & K Properties. Earnings next fiscal year, because their fiscal year runs out in June. So I've looked at the forecast for next fiscal year compared with what we don't yet know will happen this year. Analysts looking for about a 13% rise in earnings per share next fiscal year. Long-term growth, though, flat to negative, which is kind of what you're saying here, that things are good now, but they're not going to carry that way for the next few years.
Correct. I guess this would be the right way to look at this company right now. They have like solid rental income, they have excellent brand name, they're able to dispose inventory like during bad times. But in terms of growth, we think the economic fundamentals going forward are still like at least deteriorating, perhaps at a slower pace. So like in next financial year or next financial year, we might see some sort of like mild decline in terms of profitability.
Okay, but in terms of their balance sheet, I mean, you see this as a rock-solid company, basically.
Yes, correct. They have really stable EBITDA. They are not high leverage. They have really good relationships with like most of the commercial banks in Hong Kong. So their balance sheet is safe.
Their exposure, both here in Hong Kong and elsewhere, mainland China and so on, I mean, is it reasonably balanced?
I would say that they are quite balanced in that. In terms of like geographical risk management, they do it in a very prudent way. I would say like 80% of their total assets are still like located in Hong Kong and in those like safer industries. And the remaining 20%, maybe say like 15% are in China. And most of them are in say like residential properties, 5% in commercial properties. But their track record so far in mainland China are still like satisfactory.
You're right.
Yes.
Satisfactory is good.
Satisfactory.
I want to just highlight, you're a bond analyst, of course, not a stock analyst, but I do want to highlight to the viewers here that we often see credits as being a predictor of what happens with stock prices. When credit quality starts to deteriorate, stock prices can follow a little bit later. As far as Sun & K Properties goes, let's pull up the price chart of that. It's up 40% so far year to date. It's got an estimated PE now of 19. That is actually the debt rating. Can we have the price chart? There we go, price earnings of 19, price book about 1. This is estimate for next fiscal year. Average analyst price target about 3% above the last close. So, in other words, stock analysts out there are saying this stock may be fully priced, and we're seeing that about a lot of stocks around the region at the moment. Michael, we're going to take a look at another couple of Hong Kong listed property stocks in just a moment. First, so we're going to take, though, an ad break. When we come back, more with Michael Wu, Fitch Ratings Director for Asian Corporates. And we'll also take a look at some other stories here in Hong Kong, plus a look at some other trades around the region. Stay with us also for the second half of the show when we've got China's stimulus and how that is affecting Chinese stocks. Back on the Bloomberg Edge in just 2 minutes. Now, we have an email from Frank who says, what's your outlook on commercial real estate? Are there property sectors that seem attractive, and are REITs a good way to get exposure? Michael Wu of Fitch Ratings is with me today. Commercial real estate, particularly here in Hong Kong, which is your specialty. How's it looking?
Well, perhaps we need to divide commercial properties into 2 different sections first. One is office, and one is, let's say, like retail shopping malls. In terms of office, I guess everyone understands that the vacancy rate is going up. We do not see a reversion of that like going forward. So in terms of office properties, our outlook is sort of like below average. And in terms of retail properties, it really depending on like where you are. But we understand that going forward, particularly in Tsim Sha Tsui, there will be lots of new supply, and they're in really prime location in Tsim Sha Tsui, very close to the subway station. So I would say that retail sales, in terms of like retail shopping malls, the price will be going downward as well. And at the same juncture, retail properties in terms of the performance is tied to retail sales. Do we see like major upside in retail sales? Not at all. If we see a flat retail sales, we are already really lucky.
Okay, and of course the leases tend to be 3-year leases in Hong Kong.
Well, in terms of office, yes.
For offices, that's right. So people could be re-signing their leases for quite a while to come. They signed them initially while we're at the top of the market. Let's take a look at a company which has quite a lot of commercial real estate then. That is Wharf Holdings here in Hong Kong. Expected to, it operates on a calendar year basis. Analysts looking for about a 7% rise in earnings this year. Dividend yield about 2.9%. And long-term growth of 4%, which is not bad, actually, is it?
Well, I guess in terms of long-term growth, if we're talking about average growth in, say, like next 3 to 5 years, I guess that will be achievable. But for this year and next year, I guess they will have some challenges. But in terms of their balance sheet, they are really successful in disposing their inventory at a lower prices in mainland China. So in terms of balance sheet, it's okay. Profitability, average growth this year, next year will be kind of tough for them. And
they've been pretty heavily exposed to mainland China. That's where a lot of the efforts have gone over recent years. As compared
to Sun Hung Kai property, yes. I guess that's the reason why Wharf is an A- and Sun Hung Kai is a single A.
Okay. Let me take a look at one heavily exposed in mainland China, and it is, in your eyes, perhaps one of the riskier bets. It is also, in stock terms, by far the biggest gainer this year out of the 3 we're talking about. This is Shimao Property. EPS forecast to rise about 14% this year, and massive long-term growth forecast amongst analysts of 42%. But you see quite a lot of risk associated with that.
Well, in fact, mainland Chinese residential property market is heavily regulatory driven. Perhaps like going forward, we can see 20%, 30%, 40% growth in any particular year. But say like they can achieve 20% growth this year, and 2010, if the regulatory environment has some sort of change, for instance, like the State Council would like to tighten up some policies, we can see like a 20% decline very easily. I guess that's the difference between the investment grade credit versus this kind of like sub-investment grade credit. Like volatility is huge.
Yeah, I mean, you've got a double B plus on the long term and the senior unsecured. Outlook is stable for this. I mean, China is concerned about keeping, as you say, it's a regulated market, and China does want to keep the market stable. So not too much risk in that sense to Shimao, presumably.
Well, I would say it's not too much risk for the market itself, but for a property developer, of course, there will be lots of time lag in terms of land bank acquisition versus when you can dispose of inventory. When you acquire a few expensive land banks, and then at the same time the government would like to tighten up, say, money supply or whatever policies, okay, you'll be in trouble.
Okay. Leverage okay with this company? It's definitely higher than Sun & K and Wharf Holdings.
Oh, yes, of course. Yes, of course.
But any concerns about the leverage at all?
I would say my biggest concern is that if the Chinese government is able to keep the GDP growth rate at something like 7.5% or 8%, then we might see some tightening up in terms of money supply or some other regulations. And at that moment, okay, we might see some liquidity pressure on Shimao Properties.
Okay, fair enough. Shimao shares, by the way, up 145% in the last 3 months. Imagine that. Average analyst price target is 13.16, which is actually a little bit higher than the last traded price of 12.58, but not much upside. But there you go, about 2%. Michael, thank you very much indeed for your time today. Michael Wu, Fitch Ratings Director for Asian Corporates. India's rupee could rise long after the initial election excitement has died down. We'll tell you a little more about that up after the break. And, of course, send us your emails, asiaedge@bloomberg.net. We're back in just a couple.